series. Today will be recorded, so you can go back and listen to it. And really, our goals for today are pretty simple, and the objectives of the whole series really to understand the integrated transition planning process, to learn the importance of your transition planning team, and to really walk away with some free tools and resources. We don't want you to just come and listen and then walk away and not have anything to take with you. There's so many free tools and resources that are going to be sprinkled throughout this entire series, so be looking for those. Below you can see today is week 1. We're going to be talking about banking, but we have a whole list of other experts that are going to be joining us over the next 6 weeks, and we would really love to be able to see you there for those. Again, this is week 1, banking, and with that, I would love to introduce one of our expert presenters, Lori Moen.
Good morning. My name is Lori Moen. I am a senior consultant with VisionOne High Performance Group, focusing in on transition planning as a business coach and a certified exit planning advisor. I'm also a recently exited business owner. I had a small business that I purchased in 2003, a trophy shop, awards and recognition. So yes, I was your trophy wife. And we had 12 employees, it's Viking Trophies, and I had bought that business as a lifestyle business, an investment, an opportunity to have a job. I'd been in radio for 25 years and decided I no longer wanted to be at the risk of getting fired. And fast forward to 2019, I successfully sold that business to my general manager. And so I came through the transition planning process. And as you know, when you transition, you need a plan for after. And I became a certified exit planning advisor and business coach to walk alongside business owners, because transition planning is really just a business strategy. It's something you bring into the present tense. It's not something that you just wait for, because a transition will happen. We know that. As a business owner, you will transition at some point in time, either vertically with a plan or horizontally. So what we're here today, and then for the next 5 Thursdays in a row, is to really lay out the steps to planning your transition. So that's what I'm here for, and that's what we'll be walking through. And when you look at transition planning, it's really a 3-phase process. And again, it's a business strategy. It's a business strategy that you have in your day-to-day running of your business, because you're always working on your business, hopefully, not just in it. And as you work on your business, you're growing its value, because you want your business ready to transition. It needs to be valuable and transferable. You also need to plan for your succession. What is that? Is it a family member? Is it a management person? Is it a third person buying it? You know, what are your choices? And then what is your strategy? And the idea is to always plan with the end in mind, because every decision you make as a business owner affects your business, affects its value, growth opportunities, and how you move forward. So when you're looking at your transition planning, we believe that it is a process. It starts at that number 1 spot of identifying your goals. And then you move through a cycle. You form your transition advisory team. You identify your ideal buyer, seller, or investor type. You work on understanding your market value and the key value drivers of your business, and maximizing those qualitative and quantitative drivers. And you go around that circle, asking yourself, are you ready to grow? Are you ready to transition? And that process may be 3, 5, 10 years, but it's something that's keeping the top of your mind. And what we're looking at the next 6 weeks is the importance of that transition team. You don't need to do it by yourself. You don't want to do it by yourself. Because if you do it by yourself, you may miss a step, you may leave money on the table, you may have a bigger tax bill than you need. And again, you are the expert on running your business. Let other experts walk alongside you and sit at the table with you. as you work through your transition. So as we move forward, you've got a process. Right now, you have this huge amount of baby boomer owners. And sadly, the majority of business owners, and I know I was one of them for a long time, that I did not have a plan. You don't have a plan. You think, oh, you know what, that's 5 years in the future. That's 10 years in the future. You know, I plan to sell my business in 1 to 2 years. I'll worry about it later. And you can do that. But then when you bring your business to market or to transition and you're attempting to sell it, it's not ready. It's rejected. You know, we as business owners think our baby is gorgeous, and it is. But you want to make sure other people think it's gorgeous too. Because when you want to go to transition, you want it to be accepted, and you want to not fail through that transaction. And you also want to make sure that that transaction is successful and it integrates. Not just a transaction of the business transitioning, but your own life transition as well. So when you look at getting started, there's a lot of elements to it. It's a lot of mindset changes. Looking at your owner mindset, you want to start early. You want to have a formal plan. You want to have those roles identified, whether it be for your management team going forward, for yourself. Another thing to consider doing as a privately held company is having a board of advisors, a transition planning team. You want to be ready, because again, if everything is aligned, you have a greater success of managing that transition, having it be successful. When we look at our teams, when we look at our advisory teams, keep in mind the idea is a transition is a three-legged stool. And in order for it to be successful, all legs have to be in alignment. Your business leg, your financial leg, and don't forget your personal leg. So you'll work with your advisors to get all of those legs in alignment, strong and steady. Because if one of them is out of whack, that's when the issues happen. So it's a business side, making sure that business is ready financially, that your finances are in order, both personal and business, and you've looked at what you need to be successful post-transition, and then personal. That's the one that sometimes gets forgotten. We forget to think about what's life like after owning a business. If you've gotten up every day to run your business, start your business, run your business, and that goes away, what's going to get you out of bed? What will bring that passion to life? People can say, oh, they'll play golf, they'll travel, they'll go to the beach, and you'll do those things, but you need to have a clear path so you don't find yourself disappointed and unhappy. And here are some of the people that can take up a chair at your table of your transition planning team. And some of these people will come in and out. They'll serve a need, then they'll go back, and then another person will come forward. But the idea is to bring all these people together so you're all on the same page, that you're working together. You're working together to make this life transition successful. So these are the different chairs at the table that we'll be talking about with our experts over the next 6 weeks. There's also forces that influence your transition. There's some that you can control. The personal forces, your wealth plan, your succession plan, your legacy plan. The business forces you can control and work on, working on the qualitative and quantitative value of your business. Some of the forces are out of your control. The external forces. I mean, look at what the world we're in today. With this pandemic, this external force, it's doing things to our businesses that we have no control over. But what you can control is making sure that your personal forces, your mindset are such. It's also meaning that, you know what, you may be hitting a pause right now. You may have a plan in place and you thought you were going to transition in 3 years, but all of a sudden you're concerned about the value of your company. So you need to take a step back and work on the value growth elements. You may have thought you were truly identified with what kind of buyer type or transition plan you had who it might be going to, and that might be changing because of some external forces. So we're here to help you educate yourself, gain some knowledge, gain some confidence, and not be alone on this journey, because it's a journey that will impact you greatly for the rest of your life. So now we know what we'd like to cover between Melissa, our banking partner, and myself, but we want to hear what you want to walk away with today. So what key questions around banking, around business banking, do you want answered today? And we will make sure over the course of the next hour and 10 minutes that we hit those elements, whether it's in our plan or not. What do you want to have answered? So feel free to take a minute, type them in the chat box, and at any time while you're hearing and interacting, feel free to type your questions, or if you need something clarified, in the chat box. Brittany, who's the marketing person, director of VisionOne, she'll be managing that so we can make sure we're fulfilling on your expectations and hopefully exceeding them. So now we're going to start with a poll. So Brittany will put the poll up. The first question is, do you know the name of your banker? Not your bank. Do you know the name of your banker? And then the second question, how would you describe your relationship with your banker? And you've got 4 choices there. You don't have a relationship with your banker. You have somewhat of a relationship, a good relationship, or an excellent relationship. So please take a minute, answer the poll questions if you could, and press submit, and we will get rolling. How are we doing, Brittany? Do you have some more responses to come in?
We have a couple more responses to come in. I'm just going to end it in about 5 seconds. So if you haven't participated in the poll, get in on it now. We're just going to let it run, and we're done.
Perfect. Thank you.
You're welcome.
So now I'd like to introduce you to our expert panelist today. And her name is Melissa Johnston. She's a senior commercial banker at Highland Bank. And I would like to give you a little bit of history of how I know Melissa. So as I mentioned, I was a small business owner before I joined VisionOne and moved on to my next chapter. And I was part of an SBA program called Emerging Leaders, which is a free class offered through the SBA. And it was phenomenal. It was a master's level business class, if you will. And we met weekly for 3 months, lots of resources, lots of learning, and met other business owners. And it was through that class that I was introduced to Melissa at Highland Bank by another business owner, because I had a banking relationship with a big national bank, but I had no one I could talk to. I had no one I could ask questions of. And I came from 25 years of corporate. Now all of a sudden I'm a business owner, and I had some questions around financials, about impact of, and putting a mindset around how to use debt wisely. But I had no one to ask, because I was a business owner working in my business. And I got the acquaintance of Melissa Johnston, and talk about phenomenal. Here was a go-to person at a community bank that I became, I had a relationship with, I knew and trusted, and was an absolute resource for me. Fast forward, as I'm ready to get my business ready to sell, she's working with me on getting it ready to sell. And guess what? Her bank, through the SBA, financed the purchaser, my general manager. So, it is with great pleasure that I introduce an amazing business banking resource, Melissa Johnston from Highland Bank.
Oh, thank you, Lori. That is
You're
so
welcome.
sweet. It makes my eyes wet a little bit. Think about that journey. Well, thank you for joining us today. It's fun to see a few familiar names in the group and a couple new folks. So congratulations for taking the time today to work on your business instead of in your business. As Lori says, it's easy to get into the details, especially now when all of us are so concerned about our people, our culture, just sort of trying to triage during this uncertain time. So thanks for taking some time. I know it's precious. The results of the survey, thanks to those of you that participated in the survey. I do have a couple clients on the line, so it was nice to see a whopping 43% of people on the phone have an excellent relationship with their bank, so that's wonderful. There's a couple people that don't know their banker's name, if I do the math right, based on the 14%. And then a few don't have a relationship with their bank. So hopefully after today, you will feel inspired to really learn about the resource that your banker can be for you during the exit planning process, and just really for business in general. There's a number of really good bankers out there that can walk you through sort of a financial view and lens of your business that, as you continue to grow, can be extremely valuable. So we'll just start off here with a few I mentioned the value of the relationship with your banker. So Brittany, if you just want to show that slide quickly, I touched on most of that. With a relationship with your banker, I think the item that comes to mind for me and likely all of you is just the PPP. It was clear during that process that those people that had a relationship with their banker and their bank, they got quick feedback on if they were going to be able to do a PPP loan, to get the loan approved, and then ultimately get it closed. So that's a recent example of how a personalized attention can really help during a time that you need it. And then talking through kind of some of the banking and financial best practices, some of the lenses that we look through. Starting with accounting controls, it's interesting when I talk to folks getting their business ready to sell, and you'll hear a little bit more of this on the accounting side. We have that one coming up in a few weeks. But basically, on the accounting controls, having someone in your office to really monitor that process and making sure that the person that monitors the account is different than the person that writes the checks. It can be just devastating for those of you that haven't endured any internal fraud on your with your business. It can just be awful when you uncover something on an internal fraud situation. So really putting those accounting controls in place is going to be critical. And then some of the fraud identification services that banks have can also be helpful. The ACH alert program, the positive pay. With the ACH alert, you can provide a list to your bank of those companies or individuals that are authorized to debit your account, and also indicate the amount or the range that they are authorized to do. And so that some random vendor doesn't go in and pull funds out of your account. Someone within your company will get an alert saying that there's a unusual transaction pending. On top of that, the positive pay program, that's a program that helps with the check writing aspect. So believe it or not, there's still check fraud out there, and that's another one that's just a real tough situation. And the check may clear your account for the right amount, but I had a client, and he was writing checks to a vendor who happened to be in Canada. The checks were clearing, they were balancing their books at the end of the month, and then that vendor called 3 months after one of the payments was due and asked why they were past due. And my client went back and looked at the account and saw that the check cleared, and then looked up a copy of the check, and the check payee had been chemically washed. And so there was a new payee listed there. That check cleared for that amount. And so he had already passed the 30-day time frame to submit a claim on a check. It had been 90 days, and unfortunately had to work with his insurance company on that. So there's still unfortunate check fraud out there. I had a client that paid his real estate taxes, put the checks in the mailbox, the checks cleared the account, and turns out chemically washed, his real estate taxes weren't paid. So by using the Positive Pay program, you can submit a whitelist of all the checks that you have, the amounts, and the payee, and the bank will match that up and send you a notice if something doesn't align. So just some nice tools there. And then in this day and age, we all know about cybersecurity. I mean, I feel like someone's getting hacked every day in the news. I mean, Garmin recently, what did they have to pay a $10 million amount for ransomware? So just really being up to date on that cybersecurity piece. And now with people working from home, really talking through, you know, what equipment they're using. I know several folks are preferring to use their home computer versus work provided PC, which then just opens them up for some malware and that type of thing. So just really making sure that virus protection is up to speed. And then when you think about the financials and the bookkeeping aspect, Brittany, if you want to show that slide, I think it's number 16 or so, we have some guidelines around what quality of the financials may be helpful. So I talked about those first few bullet points, but for companies with revenue size in that $1 to $3 million range, we generally recommend a compiled level financial. And if you're in that 3 to 6 million, it's reviewed. And then anything above 6 million, it's really helpful to have audited financials. I know they're expensive, but as you're preparing to exit that look back period for 3 to 5 years, the number of questions you're going to get asked when you provide audited financials decreases dramatically. So saving you time and money on the back end. 6 million may be on the lower end, but bankers like high quality financials. So I put that in there. And again, our accountant expert will talk a little bit more about that. And then making sure they're in GAAP basis is also really helpful.
It's interesting, Melissa, the things you're laying out here for best practices.
Yeah.
They have everything to do with transition, but they have everything to do with simply running your business at the highest level possible, which is which is why the idea is transition planning is a business strategy in the present tense.
Correct. Thank you. Mm-hmm. Yes, that's a terrific point. Yeah. So then going on a little bit more of the lens of the transition planning, as we talked about, entrepreneurs can be intimidated by the numbers, and just really being able to answer their buyers' questions when it comes to the financials is going to be critical. And any of my clients will tell you that I'm not afraid to ask questions and help you get ready for that piece, to just really know what your margins are, what your ratios are, what your goals are, and making sure everything lines up. I was working with a manufacturing company, and they were looking to buy another company, and going through that process and got the financials from the seller. And it's always interesting to see what the sellers add back into their financials. And it's rare for me to see a financial statement without any add backs. There's always something that comes up that the seller feels is important to add back to sort of right size the EBITDA.
Sure.
And this particular company, they were adding back some legal and insurance expenses. And it turns out the seller owns another company, a robotics company that was already losing money. So they were taking some of their legal and insurance costs and putting it on their manufacturing company to try to offset some of their income on that company. And so the seller was saying, well, here's what my EBITDA showed, but here's what it actually is, because these particular expenses are part of this other robotics company. So my bottom line is higher. And while that may be true, it's certainly not legal, although there's some gray area there. And it just brings up all sorts of other questions when it comes to the financials. You know, are they really going to be accurate? So trying to, as they say, really clean up the books during those last 3 to 5 years is going to be critical when it comes to working with buyers, because sophisticated buyers, they are just going to rip apart the numbers and make sure everything is presented accurately. And also, as deal sizes get larger and companies are larger, there's often an earnings report that gets done, and it's called a quality of earnings, or a QE. And so that would be where they hire a CPA firm and really evaluate the numbers, make sure they make sense and are represented well. And so to just be thoughtful about that, and like I said, spending more money on the front end to make sure your bookkeeping is right is going to save you a lot of hassle.
Plus, if you start with that, if you lead with that as your mode of operation, it's saving you time. I mean, you enjoy that growth, you enjoy that benefit from the get-go, and you don't have to scurry and do it again, or do it, go backwards and try to do it.
Yes, totally. So a lot of my clients will talk with me about how to grow their business. How do I add value? What can I do to get my company so that it's valued greater? And so John Warlow is a favorite of mine. He also has a podcast, Built to Sell, that's really good. And he says 76% of business owners will exit their company in the next 10 years. And so there's some really good tools out there to look into. They're up on the slide here. This is just a small list. And I know a couple folks on the call also help with this type of thing. The Value Builder System, Arcona Intentional Growth Principles, Profit Builders Network, and of course EOS, the traction base that I know a few folks are on. So interesting story there with that too on the value growth. I have a client right now where the business has actually been sold 3 times and still banks with me. So it's been really interesting to see how different owners approach the same business. This particular business is a home services company. So they do gutters, gutter repair, window cleaning, and that sort of thing. And the most recent buyer was a strategic buyer. And so he owns a residential and commercial cleaning company, interior cleaning, and was looking for an add-on and thought that a window cleaning company might be a good fit. And so that's been the most recent acquire, and it's been so interesting to see how he's really been able to grow that business by cross-selling across the different businesses, where some of the residential folks that they clean for maybe hadn't thought about getting their windows cleaned, and so kind of running those cross promotions and that sort of thing has been an interesting way for them to grow their core business. And now he's in the process of merging them together into one company. So we'll see what his exit strategy is, and if I can retain it for a 4th buyer. So that's just, there's always different ways and different value that can be brought to companies. And some examples, a lot of folks will come to me and ask about, on the revenue side, you know, how do I get contracts signed to get that recurring revenue? A lot of buyers are looking for recurring revenue, and contracts are a big thing. So anything that you can do in your business to demonstrate that your revenue isn't project-based, it's repeatable. And then another aspect that buyers get hung up on is concentrations. If you have a couple, 2 or 3 key clients that bring in 75% of your business, that's going to be troublesome for a lot of buyers. So really trying to diversify that revenue base is something that we talk about. And I have a couple clients right now that just have extreme concentrations, and they're good clients for them, and they want to keep them, but it comes down to being thoughtful about how to either lock them up with a contract and or continuing to try to just get that client base a little more diversified.
Absolutely, because that then all goes to the idea of de-risking your business. You know, finding ways to make your business less risky, because that when you transition, that new owner, that new management group, that family member, if it's a next gen, they need to know that they can go forward with that business and it's not as risky, that it's not all about you as the owner, that there's not only, as Melissa mentioned, not concentration on the customer side, but you're also not heavily dependent on one particular supplier or one particular employee, or that it's not all about you.
Yep, huge. Yeah, and so the other aspect that we get some questions about is when it comes to the valuation. And this slide has too many words on it, but it's all good. So the valuation world, it's really all about cash flow. There are generally a few, I think someone maybe needs to be on mute, getting a little feedback, someone maybe getting into their car. There's a few instances where an asset sale may be appropriate. But generally, any buyer is going to want to see that cash flow. What does the cash flow look like? They'll put some multiple on that, and that's going to be what your valuation is. The valuation experts typically use the discounted cash flow method, and so now all the conversations we kind of laugh about it, but it's going to be a real life situation where we no longer have EBITDA. It's going to be EBITDAC, and we're adding back coronavirus. And it could be negative or positive. Not that coronavirus is positive. However, there's been opportunities whereby a business has been able to grow with the coronavirus. I have a freight forwarder. It's a freight broker. And they have seen tremendous uptick in their business, and we're looking at buying another business similar to theirs in a different state. And so we've been going through the due diligence on that, and how that company has grown in 2020 compared to 2019 makes evaluation really tricky, because do you base the valuation on 2019 numbers, which is the most recent fiscal year end, or do you look at what they've done year to date? You know, we're over halfway through this year, and count that into the valuation. And how long is this sort of new normal going to be, where companies have pivoted, there's growth in certain areas, and their delivery trucks, I mean, they're turning business down. They can define their own margins for them. And so we're talking with them and sort of sensitizing down the 2020 cash flow to say, you know, what's it going to be like in 2022, 2023, because you're not going to pay your loan off in 2 years. Right. So this coronavirus has really taken the valuation world into a tailspin, trying to evaluate businesses. Lori, what was your valuation methodology? How did you approach that?
When I approached it back, the first time I had the company evaluated, I was working with my accounting firm at the time. And they were trying to use some comps, but it really, because of the NAIC code I was in, it was pretty general. So, I mean, it was looking at historical, it was looking at, you know, it was a factor, but it was looking forward thinking. Sure. But it was all those value drivers that you had mentioned that benefited me, because I was able to demonstrate the reoccurring revenue, the fact that having gone through even the 2008 recession and seen the company continue with some growth and profitability. So when you look at the effects of the coronavirus, even more so those intangible assets, to be able to demonstrate that you have a diversification of customers, you have reoccurring revenue. I think those intangibles almost become even more important because of this disruption of the current world. And you can show that it's not as risky, you know, that you will be coming through it.
Yes, for sure. Yeah, so I'm working with a seller. They're not a client of mine, but sometimes I get folks that reach out to me just to talk, sort of get in the mindset of what a buyer might be looking at. And so he shared his financials about halfway through the year last year and said he was looking at selling and was just curious if he got a buyer, kind of how we would look at it from a financing perspective. And then this year, so he sent me financials, equipment appraisal, real estate appraisal, the normal due diligence pieces. And so we've stayed engaged. And then this year, just a few weeks ago, actually, he sent me an updated equipment appraisal. And he said, would this increase the value of my business? And it's like, well, maybe, but what's your cash flow? You know, people want to know what their business is valued based on the assets. And it's really not about that. It's really how much cash is your company generating? Can your company succeed without you? Because the buyer is going to want to see that it's able to continue as a recurring revenue model. And it's really hard to get folks into that line of thinking.
Sure.
Obviously, with services businesses, it's easier because they have their people, they have their goodwill, and they have their cash flow, and maybe some patented models and so forth. But it's so interesting on the companies that are heavy on the asset side, how they want to use those assets to really help them drive the valuation. And it's really about the cash flow.
Right. Well, and being able to demonstrate that the company cash flow going forward will allow, however it's transitioning, that buyer to service that debt.
Yes. Yeah, so just make sure I touched on everything in the valuation world. Brittany, maybe you want to show that slide one more time. We'll make sure we addressed everything. I think one thing I want to mention back on valuation is people don't always think about this, but the external financing market plays a key role in the valuation. How much the buyers are going to be able to get for financing actually helps to drive the value of the company, which people don't always think about. But if you think about it from a perspective of a strategic buyer and they're looking for a specific ROI, if they're not able to get financing at 50% of the capital structure, their ROI goes down, their offer goes down. And so it's really important for sellers to, as Lori mentioned, understand who your buyer is. Is it going to be a strategic buyer or a financial buyer, or what I like to say is a corporate refugee? Who's going to be buying your company? Who's the most likely candidate, the key employee, and so forth? And then understanding how the external financing market plays a role in that, so you can have a pulse on an expectation on what you're going to be able to sell your business for. And we'll talk about this more at the end, but it's interesting right now with financial markets. At Highland Bank, we haven't changed any of our lending guidance. I think we are going to see how this year plays out. I've been talking to our chief credit officer regularly about this, and we have an audit coming up. The FDIC is going to be here late this summer. And so I think it's going to have something to do with that, kind of what's the government's take on banks and banks' performance, and is that going to cause banks to tighten up with their lending? During the last recession, it did, which this isn't a recession technically, and it's an economic downturn. And it's interesting because the last recession was more driven by the financial markets. Banks were part of the problem and how much they were leveraging up companies. In this situation, it's a health reason that's really impacted the downturn. And so maybe with banks not to blame so much, maybe the regulators aren't going to be quite so tough on banks And so as a result, lending may stay where it's at. But it's too early to tell. Like anything else, right now, we don't know what the recovery is going to look like. We don't know how businesses are going to come back, and we don't know how banks are going to react to it. Obviously, if borrowers stop paying things back and banks have to take a loss on a number of their assets, that's going to impact their capital and therefore their lending. And so I'm really interested to see how this is going to play out and impact my bank and other banks in what businesses are going to be able to borrow, and of course everyone's asking, and so so that's something that we're going to be keeping an eye on. Obviously, the PPP loans have artificially propped up businesses, which they needed to. Businesses needed to get money to keep their people employed and to get through this time that was unexpected. And so we actually, our base deposit, our core deposit ratio is actually up relative to our loans. Our clients have more money on deposit than they do on loans, which is something we haven't seen since prior to the last recession. I mean, it's
Got it.
And we attribute that to the support they've been getting from the government. So
Sure.
we don't know when that's going to turn around.
Yeah. I just want to say I enjoyed the, as you look at the different kinds of buyers or transition partners and, outside of family or a management team, the corporate refugee, I guess that's what I was. I was a corporate refugee and I had not heard that before. So that draws a good picture to mind of a category of a buyer that you can consider.
Right,
Definitely.
right. And I work with a lot of them, and I personally like them. It really is rewarding for me to see someone go from their high-paying corporate life where they may be traveling, they may not like the culture. There's typically about 5 things that are driving them to buy their own business. And now with the flexibility that a lot of corporations have offered, I'm really also interested to see if that goes down, if folks are going to stay content with their benefits and their jobs, or if we're going to see the entrepreneurs popping up again. There's just so many things that are too early to tell, but we all know corporate travel is down. So and that really is what burns out those people that are working in corporate. So
sure.
So like I said, a lot of folks will ask me, and actually a few clients right now are in a position to do a strategic acquisition. And so they're saying, how much money can I borrow? If I'm looking to buy a company, what do those parameters look like? And so I put together a slide that I think may guide some of that. And again, it all comes down to underwriting, because there are so many facets within the credit analysis piece. But in general, our SBA loan, which is the most popular for business acquisitions based on the size of the companies that we work with, typically it lines up about 75% of the total project cost. So I put project cost because when you're buying a business, it's more than just the purchase price. There's going to be some working capital that's needed. There's going to be some closing costs, could be some equipment, some other aspects that go into it. So generally banks will go to 75% of the project cost to do an SBA loan. And then the rest will come from equity. And that equity can include seller financing. And I'm seeing a lot more of that now. We went through a period 2013 through last year, where sellers weren't really needing to finance their buyers. Banks want them to, and the buyers want them to do some risk sharing. But based on the market, it was really a seller's market. And so they don't want to take any more risk than they have to. And so we would see seller notes in the 10% range, occasionally higher, again, depending on the nature of the business. But now I'm seeing a lot more risk sharing. Sellers are really stepping up and offering to help carry some of that debt, which helps the bank and helps the buyer. And so So we can include that as equity as long as the seller is willing to be subordinate to the bank, meaning they're in second position on assets. And then the debt service coverage. So 2 out of the last 3 fiscal years need to have positive debt coverage in the 1.15 range. And then we have to apply the pro forma debt. So if you're taking out a $750,000 loan, for example, we have to take that debt and put it on the last 3 years historical financials and make sure that the cash flow is that 1.15 or higher. And often if there's an underlying company that's going with the acquisition, there's some gray area there on what earnings that can be counted in that ratio. And so really working with your bank and making sure that you both understand how those are all being calculated is going to be critical as part of your application process.
Well, and as the seller, knowing this ahead of time, you can plan, you can work with your banker as one of your partners to make those plans and be putting those practices into place, you know, and bringing that business up to the least risky it can be, growing its value. So you as a seller know that you are selling something that, you know, doesn't have a lot of lipstick on the pig. It's solid. Right. Because you want that buyer to be successful. If you've got skin in the game, you want and need that buyer to be successful. So you don't have to look at that equity or that seller financing as something that is at high at risk for yourself.
Totally. Yeah, and some folks will also ask me about earnouts. And earnouts are fine. Earnouts are good, and I'm expecting to see more earnout agreements in the future as well. Earnouts, however, are not allowed under the SBA program because the purchase price then will change, and SBA really demands that the purchase price is static. And so if there is an earnout agreement, that doesn't preclude you from getting financing. It just takes out the SBA program. So
sure.
So that's that piece. And then Highland Bank, even though we are a small business bank, we do offer financing to private equity groups, family offices, search funds, other folks where they don't want to provide that personal guarantee. And in those cases, our loan amounts are limited to 50% of the capital structure. So if you're so it's basically 50% of the project. So if you're coming in with a senior loan as a private equity group, and I don't see a couple of them registered for today, but I don't see them on the call, but they'll probably get the recording. Oftentimes those will come in with mezzanine lending, some sort of other subordinate lender, and that's where we're at 3.5 times EBITDA as our max senior loan amount. And so the subordinate lenders may come in with a additional debt layer to help support the project, but we limit it to 3.5. And back during the last downturn, and Dave can relate to this as well, you know, banks were dialing that back to 2.5 times, and that's where that 1 turn of leverage or 1 turn of cash flow really impacts the whole deal. And so. So we're still at 3.5 times EBITDA. I haven't heard any of those guidelines changing, and I'm really interested to see what will come of that. And this one has a higher debt service coverage requirement, and that's in the 1.35 range, just because there's no personal guarantees.
Sure.
And so oftentimes banks will also put in, if they're doing leveraged lending, which is a term that's coined for that type. They will also include a cash scoop because there are no personal guarantees. And so at the end of every year, after the debt service is paid, there's a certain percent of the EBITDA that automatically needs to get paid down on the debt to help reduce that airball, as banks like to call it. So
sure. And as a business owner, you want to not have to become an expert on all these things. Totally. And that's why you have partners walking alongside you, so they can keep you educated just enough to be making wise decisions.
Right. Yes, because it wouldn't be unusual for my clients to sell to private equity. I've had a couple of them sell and won at the height of the market, 2017. He sold his company for 7 times EBITDA to a private equity firm. So I'm not sure how they're doing today, but he is out.
Sure, sure. Well, we are just about a little over halfway done. I think we have a poll coming up.
Oh, right.
Is that right?
Yes, we do have a poll coming up. We were going to see if it made sense to talk about PPP loans. Some people are probably ready for this to be over. Others may still have questions. So yeah, that's a great idea. Let's do the poll. Thank you, Lori. So
Sure.
yes or no, did you obtain a PPP loan? And then yes or no, do you still have questions about the loan forgiveness and the process? I have a couple slides put together that I've shared on previous presentations that I've updated, because as you all know, the program continues to change and guidance continues to come out. So if you could fill those out, that would be terrific. And then I'll just mention that the application, if you haven't received a PPP loan, you can still get one through tomorrow. So the PPP loan second wave is going to be was extended through tomorrow. There's conversations about a second one. Wow, 100% got a PPP loan. Still have questions about loan forgiveness in the process. We've got 40%. So I'll take a little bit of time. The slides are in here, and I can also follow up with anyone that still has a few questions on that piece. So the PPP loan process, that was fast and furious, and now we're into the forgiveness. So the payroll protection program forgiveness is what this is mainly about here, and that banks are able to now submit their forgiveness application starting on Monday. So even though it feels like we've been talking about PPP forgiveness forever, banks haven't even been able to submit the forgiveness applications off to the SBA yet. So starting on Monday, banks can do that. I know we've had a few come in, and so we're reviewing those processes, and there's a simplified version, and that's the 3508EZ that can be filled out, and the other one is just the normal calculation form. So some banks have reverted to a calculator to help folks, sort of like the TurboTax of PPP loans, and that's what we've done. And so talk with your bank if you haven't yet to see if they have a calculator that can guide you through filling out the application, because it is a little bit confusing. And then moving on to our next slide on the PPP forgiveness, everyone was excited to see that the covered period was extended for 24 weeks, as a lot of folks, specifically in the hospitality industry, weren't able to bring back their people during that 8-week time period. So folks now have the 24 weeks, which is covered. And however, if you do use up all of your PPP funds, you can submit them earlier than 24 weeks, even if you're wanting that longer period. If it's 10 or 12 weeks, you can send it in then. Then moving on to the payment side of things, we know they must be in service prior to February 15th. For employee reductions between February 15th and April 26th, the businesses must restore their headcount by December 31st, which is also nice. It was much earlier. They've extended that out to give folks more time to bring their people back. As some of you have painfully experienced, some folks that are on unemployment haven't wanted to come back to work. They've preferred to collect their unemployment, and that's been a little bit tricky for businesses to restore their headcount. So hopefully now by the end of the year, businesses can do that. There are also some safe harbors, which was nice to see, for areas where there was government guidance issued. If your business had to comply with that and it impacted your ability to open, there's a safe harbor for that. And if you document the fact that you tried to bring people back to your business, but you weren't able to, they turned down the offer, you're not going to be penalized for that. So there is some good relief within the bill. And then, as it says, document everything. I was expecting to see that they would have a certain threshold of the loan where if you received a loan, let's say in the $150,000 or $200,000 range, it would be automatically forgiven. There's been a lot of lobbying for that. Unfortunately, that hasn't come to life. So maybe in the next round, if there's a third round of PPP where folks can get a second PPP loan, perhaps that will come into play there. We're hoping for that for our clients. And I know we've got a couple other pieces. So the deferral date, as I mentioned, 10 months after your covered period is the deadline you have to submit it. So even though a lot of people are anxious to submit their forgiveness application, you actually have 10 months after your covered period. So if you elect a 24-week covered period, after that 24-week period, then you have another 10 months before you need to submit your forgiveness application. So that's nice to see. There isn't a rush, and then your bank has 60 days to review the application, and then the SBA has 90 days to review the bank's work. So there is some time in there before you'll hear back specifically on if your entire loan is forgiven. It looks like most businesses will be able to get their entire loan forgiven. Of course, everything is nuanced from that standpoint. And then you will have up to 5 years if your bank allows you to. If you have part of your loan that's not forgiven, the government will allow you up to 5 years to pay that back. That's something you'll need to work with the bank on. The banks don't have to give you that full 5 years, which I thought was kind of interesting. So if you don't have your entire loan forgiven, it's good to check with your bank right away on what they're expecting of you, if they expect you to pay it back in a year, 2 years, or if they'll give you a longer time period. So some critical pieces there on the PPP loan. I think that was it on the PPP, and then maybe we wanted to see if, so if you have questions, we say there's no such thing as free lunch. However, with Highland Bank, there is. We are offering a free lunch to anyone on today's call, in today's session, that wants to have a little deeper dive into any of the banking questions or issues, or want to bring up a certain scenario when it comes to selling your business. Myself or one of my team members are happy to take you to lunch and talk through it. No cost, no obligation, just get to know you a little better and see if there's an opportunity for us to help navigate whatever you may be going through.
That's terrific. Just to have that resource, another set of eyes to look on, your business and answer those questions you might have. Thank you. That's very valuable.
Thank you. Yeah, we're excited. And we have a number of restaurant clients that will be thrilled to have our business. So we will try to identify something that will work well for people that want to do that. So
perfect.
We have another poll coming up that will help me kind of determine the last 15 minutes or so of what I want to share. So I'm curious if folks are looking, some businesses I know are hitting the pause or are doing some internal transformation and maybe aren't looking at additional capital or financing. And I know others are kind of still trying to get a handle on what may be available to them when it comes to outside capital. And so if you're looking into options for additional capital or financing, I'd like to cover that. If you're not, we'll move on to something else. And then some of you may have heard of the Main Street lending program. It's been a buzz the last couple months. So I have some information on that. If anyone is interested in learning a little bit more about the Main Street loan, or if you're not, we don't want to bring that up if it's not something that's on your mind. So help us kind of guide the last 15 minutes or so of my piece, and then we'll wrap it up with Lori. maybe give a minute left for the poll, or did you show me the poll, Brittany, and I?
Yep, you should be able to view the poll now.
Okay, unfortunately, something must have gotten unstable with my internet because it didn't come up.
Well, it's showing that 67% are not looking into options for additional capital and financing.
Okay.
So 33% are. On the Main Street Lending Program, we have 33% are interested in learning about it or in it, and 67% are not.
Okay, all right, terrific. So that'll guide me on how much time I spend on this additional lending and financing option. So for those of you that have existing business loans by this time, you may have talked with your bank about what they're willing to do for you. A lot of banks have offered 3 months of no payments, or perhaps even interest only for 6 months. Banks don't want you to go out of business, no matter how nice your equipment is or how beautiful your property is. They don't want it. They don't want to take it back. So they really do want to work with their clients and to help them through this time. So talking with your bank on what they're willing to do for you is critical. And letting them know how you're going to come out on the other side of this. If you do need help, you're going to need to show how you're planning to remain viable, even with the current economic conditions, what you're doing, how you're pivoting, and that sort of thing. And then working with your landlord and your vendors. Landlords have been quite accommodating. Vendors, you need to manage your relationship, but oftentimes there's some things you can do there with your existing partners. And then the Main Street Lending Program, this was really exciting when I heard about it at first. And then as it became more developed, I wasn't quite as interested in it, although I still think there's some promise. So I put up a little graph here. I won't spend a tremendous amount of time, but there's 3 different facilities associated with this program, and they're larger loans, $250,000 up to $300 million. We're going to land in the $250,000 to maybe the $10 million range. One of the concerns for this program, at least for me, is the fact that it's a partnership with the Fed. And so it's a loan participation. The banks can't do these loans, aren't allowed to do these loans on their own. We have to participate with the Fed, which then makes any sort of changes or anything the bank wants to do for you with the loan, we have to go get approval from the government to make any sort of changes. And as many of you know, your loan isn't always static. Sometimes you want to have your amortization extended or your interest rate changed or other things. And so to just, as you're looking at this program, to just think about the fact that the bank is going to have to partner with the Fed to get this loan done. And so there's just a few different slides and then a good resource here if you want to learn more. So there is only 5 banks right now approved in the state of Minnesota to do Main Street lending. We have our documentation in to get approved as a Main Street lender. The program is running through December 31st. It originally was set to expire in September. So there is a longer time period now to get those applications in. One of the interesting bonuses of this program is you can finance existing debt with your existing lender from one type of loan into a Main Street loan. So, and the rates are 1 to 2%, and that's not for a savings account, that's a loan. So I know some people can remember when savings accounts used to pay 1 or 2%, and now those are loan rates that we're talking about, which boggles my mind. And so the Fed's primary market corporate credit facility or other Main Street lending facility if a company participated in those programs, they're not going to be able to get a Main Street loan. And
Okay.
I haven't heard yet of any of these loans closing, but there is some talk of them. So there's some of the concerns that I talked about. We won't spend a lot of time on that. And then the last little piece I wanted to scroll through was maybe some other options. I know the EIDL loans, the economic injury disaster loans, those are the 30-year fixed rate loans in the 3%, 3.25% range. And those benefit a number of my clients and businesses that I talked with. And the fact that there are still PPP funds available makes me think that if the PPP program isn't having more interest and they decide not to allow people to get a second round of PPP, my thought is the government may shift this over to the EIDL, back to the EIDL program. A lot of people really liked the EIDL program, and although it's a loan, it's in that 3% range and it's fixed for 30 years, which is unusual to get debt fixed at such a low rate for such a long term. So the payments end up being more affordable. And so that's really what I'm anticipating. But I don't think the SBA is going to ask me. So stay tuned for that. There's still some other options that I've seen. U.S. Chamber of Commerce, the Minnesota Chamber of Commerce has a website that goes into some other options for people looking at getting additional capital. Some county programs are still available. I know a number of the counties ran out of funding really early on, but Scott County still has a micro grant and forgivable loan program. And then the bonding bill is on the table. So for those that are in conversations with construction companies, that could be a nice uptick for those types of companies. It's called the Local Jobs and Projects Plan, where there's a 2.2 billion bonding bill on the table. So lots of things to sort of keep our eyes and ears open for. And then I wanted to talk a little bit about kind of the way of the world now and what folks have seen and to help you feel like you're not alone. As they say, misery loves company. So Wells Fargo Gallup Small Business Index did a little poll as of July 15th, and it was interesting and a little bit unfortunate, but the small business impact of the coronavirus, 50% of businesses had a major change in service or reduction in staff. So as you know, it wasn't just you. 30% say they're operating normally. That number surprised me a little bit. But then 16% are still closed. So if you're open for business, that's wonderful. And unfortunately, not all folks were able to reopen. 50% of business owners reported pay cuts for themselves and employees. 25% laid off workers, and 40% reported unplanned expenses related to COVID. So I know a lot of my clients are really keeping an eye on the expenses. It's been completely taken a lot of folks sideways. And so really, as Lori said at the beginning, working with all the advisors on your team and how they can provide some guidance, some resources, really talking through some ideas, opportunities, challenges is really going to help you get through this time.
Absolutely. Absolutely.
And then I think we had a couple key takeaways from my piece, and then I'll let Lori bring it home. And if we have a little bit of time at the end, I may give you kind of an update on what I'm seeing in the M&A and exit planning and transitioning space. So developing that relationship with your banker through good times and bad, just having that resource for you and someone that can get a decision back and be responsive in what you may need is really going to be helpful. The financial controls, keeping your financial records and statements up to date, knowing your numbers and valuation, and leaning on those partners as you go through the process. Because as I was talking to valuation experts, they're saying evaluation for businesses can change week by week. I mean, it used to be quarter by quarter, and evaluating a company as of 6/30, for example, may be different than March 31st. Well, now it's almost a weekly change. So it's extremely dynamic. Looking at those value builders, ways that make sense for your business. And then we can't say it enough, to lean on your team.
Mm-hmm. Terrific. Such great information, Melissa. I so appreciate it. And I hope for the attendees, you can take her up on her offer and have lunch with a banker, especially if you don't know your banker, just to be able to glean some information, because it's not just about transition, it's about a business strategy. And especially when you look at some of the statistics that Melissa shared for today, and the effects on COVID, you may be drawn back into working in your business because you need to right that ship. The other thing I'd like to offer is Melissa offered the free lunch with a banker. VisionOne would like to offer you the opportunity to take an assessment to see if you're ready to exit. Your business, you're working on your business is gaining value, you're working on your value growth propositions, but what about yourself? What about you as an owner? Are you personally ready to exit? And that's an important piece that sometimes we forget. We forget to look at the personal leg. And so what I have posted in the chat for you is a link for you to take this assessment, which is called the pre-score. And it's a personal readiness to exit score. It's to help you look at exiting your business without any regret, so you don't look back and go, man, I wasn't ready. The business was, because I've worked with my advisors, I've worked with my banker, my CPA, my wealth manager. The business was ready, my lawyer, but I didn't work with me. So that's really, what we at VisionOne want to help you do, is to also get yourself ready to exit. Because when you look at a transition, we talk sometimes about the 5 Ds. The 5 Ds that can happen and really impact you. And those Ds are divorce, death, disability, disaster, and disagreements. And those Ds can affect a business owner, and that's when 50% of the exits happen. But they can also affect your team. And that can cause you to have to pivot, to take a swerve. And you look at today's world with the disaster of this pandemic, that's impacting your business and maybe your plans. And so you want to have a plan, you want to have a business strategy. So as you plan your transition, as you plan and working on your business, one of the 5 Ds doesn't all of a sudden come up and have you left high and dry because you didn't have a plan B. So when you're looking at the whole picture of your transition, we have some elements to look at outside of the 5 Ds. We have the owner readiness, which I mentioned, by taking the assessment of the pre-score can help you as the owner personally get ready. We have the business readiness. A lot of the things that Melissa talked about and we'll be talking about over the next 5 weeks is getting that business ready and using the power of your team to impact that as you define your next act, because you will have a next act. If you do the simple math of looking at, your age, how old your parents are, when you're planning to retire, there's a whole big span of years. And so what is that next act? And then a lot of the upcoming weeks, and Melissa touched on it, is having that playbook ready, having those financials cleaned up. Those are just good business strategy elements, and in getting the next generation ready. You want to prepare that next generation. You want to prepare to make that transition successful. And then as the leader of your business, you need to communicate that, because you want that integration to happen so it can be successful. So you can measure your transition, you can measure your plan, and then adapt it into the next transition. Because when you look at the steps of your transition and you look at what we talked about here today, and you'll be hearing it about it in the upcoming weeks, is value. Well, what is the definition of value? You know what you think your business is valued at. A buyer may have a different idea of value, but it's really that fair return. And it's the monetary work of something, that relative work, utility, or importance when you look at the dictionary definition of value. And as a business owner, when you look at your strategic value, on the left side of the equation, when you're looking at the valuation of your business, it can be valued against your cash, it can be valued against your sales, and it's always times a multiple. And Melissa talked about that. And that gives you your value. Well, what you can do is work on your strategies to influence that value, taking in some of the steps that Melissa talked about, that you'll hear over the upcoming weeks. Those qualitative and quantitative things that can drive where you are in that multiple range, so you can maximize your value as you work through your business. And again, while you're doing this now in the day-to-day, you as the business owner get to enjoy, you reap those rewards, even if your transition isn't for 5 or 10 years, because your business is gaining in value, you're gaining in profitability, you're gaining in cash flow, and you as the business owner get to enjoy that. Because the goal is to always be asking yourself, where are you in this process? Are you ready to sell and transition, or are you staying and growing? Sometimes, and we've seen it here at VisionOne, and Melissa, I bet you've seen it too, and our other advisors will have seen it too, where all of a sudden a business owner is engaged in working on their business, they're growing, and they realize, wait a second, I'm going to keep staying because I'm getting to enjoy the benefits of this growth and this cleaning up of my business and getting it ready and not having it be so dependent on me. And that's terrific. That transition process, is a process. What you want to do is have it be integrated so you're not all of a sudden at your wits' end, completely exhausted, saying to your transition team, that's it, I'm done. How about planning for it and having a plan in place so you can benefit as you move through the process? Some of the things to be aware of when you're working on your transition are the things that you want to be gathering. And you'll hear this throughout the next 5 weeks. You heard it from Melissa today. Some of the things you want to have documented, making sure you have this playbook, if you will, this receptacle of all these things, copies of your contracts, standard operating procedures. That person that's taking over your business is buying the future. And they need to know it's not as risky. And boy, as a business owner, if you can show that you have things documented, no matter how big or small your business is, that's taking a risk factor out of the way of it. If you have some key employees and all of their knowledge is in their head, take the time to get that knowledge out of their head and document it. Again, as the owner, you're able to provide this to your next gen. You're able to provide this to your strategic buyer, your corporate refugee, even to be able to demonstrate to the PEG, the private equity group, that this stuff is documented. So your business is not so risky. And the financials are in order. But again, document your business, having that playbook ready to go to market. Because an opportunity may come to you, and the more you are ready, the better you are able to drive that value of your company by working on that multiple. And you want to do it in partnership with your advisors. And that's really what this series is about, is having those advisors working with you. So all of the questions are answered and you're not doing it by yourself. So you've answered the questions, you've worked with your advisors to find out the answers to some of these questions as you move forward. So in wrap up, again, if you look at what we offer to you as we wrap up, you have the opportunity to engage with us at VisionOne with finding out, are you mentally, are you in a place where you can exit your business with no regrets? And if you don't have a firm relationship with your banker, you just want to talk to a banker, a commercial banker, to have that lens, set up a lunch with the folks at Highland. So you can walk away and not only gain some knowledge from what we talked about here, but keep the conversation going. Because when we look at the transition planning process, and it's a value growth process, it's a process for running your business. It's knowing your goals through strategic planning. It's forming that team, identifying your buyer, your choices available to you, working on understanding the value of your company, and then how you can increase the value before you move off into the solution, before you move off into the negotiating an actual transaction and doing that due diligence and closing. So it's a process that is fluid, that hopefully you're engaged on regularly. And that's what we're wanting to accomplish over these next 6 weeks, is just to get a feel for where people are at and how we can walk alongside you, because it doesn't need to be a lonely journey. When I look back at the transition I went through on selling my business, you know, I had a lot of great partners that had my back. I could go to them for questions, advice, knowledge, because again, as an owner, your baby is pretty, it's beautiful, but you want to make it attractive to that next generation, that strategic buyer, that financial buyer, that management group that's taking it over, so you can exit without any regrets. So we're curious to hear from you. And for the people that were able to stay on all the way to the end, you know, what was your biggest insight or takeaway from today? Do you have an action plan, you know, based on what you heard today at this first week 1 that you want to take away and have as a result? And of course, we're always looking for feedback. You know, what could we have done differently? What can we do differently to increase the value of your learning? You've got the chat box. We'd love to get your feedback. We'd love to have you rate today's session on a 1 to 6. Being 1, it was marginally valuable, to 6, meaning it was best in class, it was hit it out of this world, as well as the speakers using that same 1 to 6. You know, this series is built to serve you. We have 5 more excellent presenters coming up, again, providing a different lens of that transition planning process. And if you've not registered for the other 5 series, we hope that you do. If you have other colleagues that you think might benefit, we invite you to invite them. But we'd love for you to give us some feedback, because there's a lot of information out there. As business owners, it can be exhausting sometimes, especially as we struggle with our own mindsets of staying positive, of staying focused and hopeful, because today's world has made us sometimes, I think, lose a little hope and wonder, what do I do? If your business all of a sudden is only throwing off 25% of the revenue it used to, that's worrisome. So what can you be looking at? Where can you bring a positive? I'd also like to go back to Melissa, if you can, and talk a little bit about the M&A slide that you had mentioned earlier on. Tell us a little bit about the current state of the M&A market.
Lovely. Yes. So it's been really interesting. And I go back and look at my notes from early March. I was actually scheduled to be on a panel for Club Entrepreneur in the middle of March to talk about exit planning in the M&A space. And it was all about the seller's market. It was all about how deal flow was just, again, staying at an all-time high like it's been. And it's just been amazing to me, and actually kind of gives me chills to think and see how the M&A space is down. You talk to anyone, they'll say 80 to 90%. I mean, deals have just completely stalled out or stopped, and it'll pick back up. But right now, just with the amount of uncertainty out there, it's really a buyer's market. And I have talked with a client who she was actually in negotiations with a buyer late at the end of last year, working through some things for her marketing company, and the conversation stalled out in March, and now they want to go back and reevaluate it, to do the valuation over. And she just has already said, I'm just going to wait another 5 years. I'm not going to sell. And so it's just an example of what I've seen. And like I said, I think the strategic buyers, there will still be some deal activity there for folks that want to do an add-on acquisition. But financial buyers, I think it's going to continue to be on pause. And the way deals are getting done now are also different. I have done a couple acquisition deals despite the extreme drop off, and with the reps and warranty insurance having greater restrictions, all the pandemics clauses, force majeure clauses, various protection measures. So deals are getting done a lot differently now, and hopeful is not a good strategy, but I remain hopeful that we'll come out of this on the other side, and companies will be stronger and have their processes in place and clear strategy. And for now, it's very quiet on the M&A side.
Absolutely. So it's a pause. It's a pause in the market, and hopefully, not even hopefully, what we're wanting to do is to give you as a business owner some ideas on how to take advantage of this pause and spend this time to work on your business. So you can be forward thinking. Brittany, were there any takeaways that you wanted to share that you heard from folks? Otherwise, next week, same time, same channel, and we will talk about community resources. Justin from the Community Venture Network and John with University of Minnesota Extension Studies will be with us, because there are community resources. You've built your company. It's a legacy. It's a legacy to your community, to your employees, and there are resources out there for you to maximize that legacy that you leave behind. So look for an email from Brittany. She'll be sending out a recording along with a slide deck. And if you've not registered for next week, we hope that you do. And other than that, Melissa, thank you. Thank you for your expertise. Thank you for your time and your presence this morning. It's greatly appreciated. You're an amazing resource.
Thank you, everyone. Thank you, Lori. Thank you, Brittany.
See you next week.
See you next week.
Bye. Thank you.
Bye. Finally, it's just us. Oh, I'm. Okay. Oh, ooh, we got a 3. That's not good. But we got some 6s for the speakers.
We got some 6s.
Well, that's good. I thought it was good too. I thought it was a little more technical.
Yep.
Melissa was more technical than I thought she would be. But maybe
that's like a banker thing too.
Yeah, absolutely. Well, and you've seen from me, I'm more touchy-feely and, all that stuff. But I think as far as how it worked,